a destruction of the old national Keynesian order and a positive moment of the creation of new institutional forms in social relations. The former can be seen as a period of crisis, the latter as the establishment of a coherent regime of accumulation. Observers living through transitional periods can lack an appreciation of the dialectical nature of change, and so fail to see the tension inherent in the collapse or undoing of seeming enduring elements into a fledgling social structure of accumulation. Thus, it was the case that initially many analysts saw neoliberalism as an effort to put back the clock to a kind of capitalism that no longer existed. There was and is a reluctance, and we see some of that here, to see the harsh new world of greater risk and destabilization of the post-war SSA accommodations as anything but an era of crisis. Yet it has decades of durability. Andrew Gamble has noted it took some time to appreciate that neoliberalism did have some distinctive new features, as the prefix neo implied, and was an integral part of the reorganization of capitalist relations which was taking place. In the longer paper, which is on the ebook websites, you can download the whole thing, which clearly, like everyone else, I'm not going to get to, is a citation to the book that Andrew's article is in, and it represents in the political science field the work of a number of leading political economists. And Terry's excellent review of the literature didn't cover the political science side because they don't write in terms of SSAs. But the discussion there of neoliberalism and a forthcoming book, which two Canadians are also political scientists are editing, which will be out early next year, is a 2-volume collection of essays on neoliberalism from the perspective of the vantage point of countries around the world, so that you have somewhere 30, 40 takes on neoliberalism. So combining a varieties of capitalism approach, which we've had alluded to, with a larger globalization neoliberalism approach, which those interested in SSA work might wish to look at, and so you should check the references. Global neoliberalism is spherically coherent, I think. Its dominant elements, attitudes, and practices are mutually reinforcing. With regard to the state-citizen relationship, the new dispensation rejects previous entitlement presumptions of welfare state provisioning and the regulatory role and participation of the state in favor of deregulation, contracting out, and privatization. The new capital labor discord is one of flexibility, higher cost of job loss, downward pressure on wages and benefits, and of individualism in place of solidarity, acceptance of unionism, and a greater degree of job security. The previous core periphery relation between the rich countries of the world system and the rest, in which the former industrialized and the latter provide the raw materials, is replaced by the emergence of newly industrializing countries and significant deindustrialization in much of the former manufacturing core, where the growth of business services and high technology sectors has become characteristic. Capital relations are therefore globalized, and complex commodity chains indicate production, with complex cooperation competition patterns among technologically sophisticated firms and unremitting pressure on suppliers and contractors. The growth of the financial sector, which is my subject, results from the need to lubricate such developments, but more than that, financialization becomes the leading sector, in my view, in the new social structure. And the reason this is less clear is because in a varieties of capitalism perspective, as has been pointed to by my fellow panelists earlier, you see the problematic impacts on places like Japan and Korea, but in a perspective of combined and uneven development, we see a unity of this pattern, and I'll deal with this as I have time. Unlike the post-war SSA, with its close long-term working relations between banks and manufacturing firms, which favored European corporatist and Japanese state-led banking patterns, global neoliberalism privileges Anglo-American finance with its focus on short-term maximizing, better suited to the needs of dramatic redeployment of capital, rapid sectoral restructuring, downsizing, plant closings, and focus on shareholder value. The slowing of the global economy and greater volatility of the final decades of the 20th century led profit seekers deeper into an array of financial speculations made potentially quite profitable by such departures as floating exchange rates and rapid growth of new centers of the semi-periphery. Is the theme of the paper, then, that finance has been central to each of the accommodations of the new conjuncture and provides an avenue of insight into the new regime. There are two important questions regarding this regime of accumulation that I wish to draw attention to. The first is, how does neoliberalism allow the greater appropriation of surplus created in production to be appropriated by the financial sector? We see in this regard the growing importance of U.S.-based financial institutions, including, of course, in the city in London and elsewhere, along with competitors based in global money market centers, in reorganizing corporate structures to maximize shareholder value, benefiting from buyouts, mergers, acquisition, and financial hedging strategies, and suggest continued growth and rising income shares for the financial sector as a result. The short time horizon of finance capital has changed the behavior of corporate America so as to distort long-term resource allocation and produce dynamic inefficiencies, which will slow growth, diminishing social capital by significantly increasing inequality and taxing the social fabric. Secondly, how seriously a destabilizing factor is the risk that payments, settlements, crises, dollar devaluation can prove broadly harmful. There are questions as to whether there has been an overreaching in this highly leveraged, debt-dependent growth model. Structural and conjectural policy aspects to this development provide reasons to believe that the self-interest of Washington policymakers, given the current military and economic power of my country, is leading to excesses and imbalances, dangerously increasing the fragility of the global economy. The first section of the paper develops an understanding of the global neoliberal conjuncture, the role of the state in its construction, and the centrality of finance to its evolution. The second part explores statistical dimensions of financialization in a global perspective and the key role of the United States, its government, and financial institutions to this development. The third considers issues of risk inherent in neoliberal financialization. A fourth, which I won't attempt, indeed I probably won't get through much of the rest, is with regard to the role of the dollar in the global political economy, and a short conclusion will suggest a larger framing of the present in history. In the countries affected by serious debt and banking problems, financial adjustment is typically accompanied by poor performance across various social indicators, and this has been true through the decades of rapid globalization, strongly supporting the view that the 2 decades, 1960 to 1980, during which national Keynesianism reigned, was a far more successful time overall for global development than the quarter century and counting of global neoliberalism, during which economic growth and social progress for the vast majority of countries has been significantly lower. Real economic growth, real global growth, averaged 4.9% in the years of the global age of national Keynesianism, which I would date uncontroversially, I think, 1950 to 1973. It was, and America has been the engine, as has been commented on, generating global demand for final goods and services, many of which are produced in Europe and which many of these economies are dependent upon. There are questions about whether the imbalance central to the U.S. ability to spend can in fact continue. Restructuring and financial liberalization has been more painful, has had consequences elsewhere which tend to be ignored as people look at the rapidly expanding areas of the global economy. As the regime of global neoliberalism consolidated, financial crises occurred with greater frequency. An IMF study found that 133 of its 181 members suffered at least one crisis involving significant banking difficulties between 1980 and 1995. In more than two-thirds of the countries for which data is available, the direct loss sustained by the governments was about equal to the country's growth of output in a good year. Some countries lost the equivalent of more than half of their annual national income. The conventional wisdom blamed these governments for following reckless patterns. Why 133 countries would all choose to follow the same reckless pattern out of ignorance is generally not explained in such discussions. But the dominant role of money center investors in initiating such capital movements was rarely acknowledged. Lenders were assisted by the international financial institutions, which rarely admonished them for their roles. However, research shows that most of the responsibility lies outside of the developing economies in question. And that literature is now quite extensive and I think quite important. Economists examining the factors which affect private capital flows from developed to developing economies distinguish push factors, conditions in the developing countries, and pull factors in the receiving ones, and find it is the push factors which dominate. In any particular conjunctural situation, it is changes in interest rates, in the amount of footloose capital, which produce waves of lending and contracting of such lending. Goldman Sachs last year estimated in, I think, an important study that only 40% of the change in the spread between developed and developing country interest rates can be attributed to domestic fundamentals in the borrowing countries. The majority of the causal impetus is thus from the lending countries. Further, the correlation between events in the financial markets of the core and their knock-on impacts for emerging markets are almost instantaneous. A Bank of England study suggests that each 100 basis points increase in the U.S. interest rate by the Federal Reserve, all else equal, is associated with 80 basis point increase in the average emerging market spread. It is, of course, true that the characteristics of the debtor economies matter, as is constantly pointed out to us, but the high correlation here is important. A high level of short-term debt carried in foreign currencies at variable interest rates compound external shocks, but the prevailing stress on debtor country era and the need for good governance in emerging market financial regulation ignores these salient factors. In the U.S., in recent years, the increasing importance of debt and financial market growth has taken a number of forms. Following the collapse of the stock market bubble 2000-2001, the Federal Reserve pursued an extended easy money policy. One result was, of course, the real estate boom, housing market speculation, construction, and related activities, the wealth effect of the steep rise in asset valuations and other borrowing stimulated growth. And I think it's important to see the effect of the creation of debt in stimulating U.S. consumption. And so that the remarkable performance that people point out for the American economy is debt-driven to a very large extent. In 2005, half of new home loans had variable interest rate mortgages, and by this year, the most popular mortgage option includes paying less than the less than the amount due each month, the difference being added to principal and subject to higher, dramatically higher interest payments in the future. The consequence of such arrangements were often ignored by eager buyers speculating that housing prices could only continue to rise. The end of the housing bubble is still an open question, may or may not have serious consequences. A very different source of debt creation was stagnant real wages and the cost of job loss, which encourages borrowing to maintain consumption levels facilitated by the banking industry targeting of low-income households with poor credit ratings. The stagnation of wages and loss of purchasing power from labor market churning came in part as a result of restructuring pressures imposed by financial markets on U.S. companies. Firms which built up large cash reserves became targets for private equity firms, which by paying a premium price take control, are able to purchase and reorganize corporations, selling off, closing down units, downsizing, and in other ways withdrawing money, loading them with debt before taking them public again. Globalization and offshoring have put further pressure on workers. The share of U.S. national income going to wages and salaries as a percentage of GDP in the U.S. in 2001 at the start of the upturn was 12.2%. At the beginning, today median income is 3% lower in real terms than at the beginning of the cyclical expansion. American families added to their debt between 2001 and 2005 at a rate 60% greater than the growth of the overall economy. The financial sector grew for other reasons as well: mergers and acquisitions, nationally and cross-border, relying on financing and assumption of debt. Internationally oriented businesses learned to hedge foreign exchange exposure and securitize accounts receivable, and banks offered a host of new financial instruments. As I'll say later on, the Council of Economic Report table that I think Michael referred to yesterday, one of the most remarkable numbers on that table is that 40% of all domestic profits of U.S. corporations go to the financial sector. This is a dramatic increase, and my paper has some of the data. It's quite likely it will increase further, and financialization comes to be, for these reasons, the dominating factor. Financialization, just definitionally, I'll offer two because I think it's important. One is Jerry Epstein, who tells us that financialization refers to the increasing importance of financial markets, financial motives, financial institutions, and financial elites in the operation of the economy and its governing institutions, both at the national and international level. As I would see it, finance capital, footless and flexible, interposes itself wherever arbitrage opportunities present themselves. It represents the increased power of abstract capital as opposed to productive capital. On another level, financialization is a policy choice of governments in alliance with internationally oriented financial institutions. It is a tool of accumulation, pushed powerfully by the American state and other money-centered governments. Along these lines, Robin Blackburn has characterized financialization, this growing and systematic power of finance and financial engineering, as gray capitalism, gray, the color gray capitalism, because relations of ownership and responsibility have become weakened or blurred. He writes, in the end, the largest and most famous of corporations have only a precarious and provisional autonomy within the new world of business. Ultimately, they are playthings of the capital markets. While perhaps somewhat exaggerated in the sense that financial markets do, after all, respond and anticipate to real values of assets, including the creditworthiness of corporations, and CEOs do have discretion over strategic decisions in meeting market demands, as well as pay, as we've been told. These financial pressures exercise powerful influence into how successfully they can do this. Blackburn is right as well when he suggests that investors consider the corporation itself as simply an accidental bundle of liabilities and assets that is there to be reorganized to maximize shareholder value. And I'm down to 5 minutes, so I will talk about what the paper deals with, so that if you have interest, you may refer to it. The point is that financialization has produced corporate capitalism from the implicit acceptance of Alfred Chandler's view of the large non-financial corporation as an integrated, coherent combination of illiquid real assets assembled to pursue long-term profits, And the vastly shorter time horizon, combined with the distorting impact of stock options, as we've been told, as the dominant form of compensation, does not bode well for growth. We have a number of studies that indicate that given the choice between growth and higher short-term profitability, CEOs, for reasons we've heard, take the short-term profitability. The U.S. financial market, the largest in the world, has 45% of global equities, over half of all private debt, security stocks. I would refer you to McKinsey & Company's very recent study and the data there. I won't go into this. I talk about the difference between the two social structures and the importance politically of the embrace of neoliberalism and of financialization. I talk some about the role of Robert Rubin, coming from the same firm that our current Secretary of the Treasury also comes from. Talk about increased risk, hedge funds, and we're going to, of course, not deal with all this, but what I do want to do is take a somewhat longer perspective, expand the time dimension in my concluding minutes here, and shift the level of analysis to focusing on the world system as a whole, so that current developments can be put in a broader historical perspective looking forward. It can be noted, but not more fully discussed, of course, that other great powers, Genoa, Holland, Great Britain, now not so Great Britain, suggest the outlines of future transformation for the U.S. economy. I'm told I should stop, and unlike others, I will not make the next 4 points. Thank you.